Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been covering the gold and silver miners extensively for a number of years now. I originally found him, I think, in 2009 on the Financial Sense website. Maybe it was 2010. And his articles made a lot of sense to me. He also covers oil production and energy return on energy invested, which is something that you will not hear almost every other oil and natural gas analyst talk about. Steve St. Angelo of the SRS Rockwell Report, thank you for joining me again.
Yeah, Jason, thanks for inviting me. A lot of interesting things happening in the market, so we've got plenty to talk about.
Yes, and before we talk about oil and energy or maybe some of the other topics that you've been putting out in your new articles, let's get an update on you from the primary gold and silver miners. So we're at, let me pull up my Kitco website real quick with the prices. We're at $12.74 gold and $16.33 an ounce silver. In your opinion, how well are the miners doing at these prices?
Jason, they're just treading water. Now, some of them, like Fresnillo, Fresnillo's producing, actually, their revenue is more gold than silver. They're known as the largest primary silver miner in the world, but they're actually producing and selling more revenue in gold than silver. But according to my analysis, the top primary silver miners, about 2/3 of them have seen a reduction in their silver production in the first 9 months of the year. And this is due to mine closures, strikes, as well as falling ore grades. So the interesting thing, though, at this price, at the current silver market price of 16 and change, they're just treading water. Some are losing money, like Coeur d'Alene is losing money. Pan American Silver is just probably breaking even. And so right now, anywhere between $15 and $17, let's say 16, that's the break-even price. So no one's making any money. Now, last year, when the price was $19, they were making some money. So I believe the market price of silver is right now, it's basically, I look at it at the floor, and that's the cost of production. And we've got some other interesting things happening. Look at Tahoe Resources. They had the shutdown of their Escobal mine in Guatemala. And I believe they're going to have a lot of trouble with that mine because it's a big deal with the locals, even though the mainstream Western press makes it seem like it's a small issue. No, it's a major issue for the locals there. They don't want that mine there. And so even though the Supreme Court allowed the company to start producing silver, there's a blockade, a road blockade that is not allowing much to go in and out. So Tahoe is really struggling with the Escobal mine. So basically,
and how much annual silver production was, for our listeners out there who are not familiar with the mine, how much annual silver production was Tahoe producing?
Oh gosh, Tahoe's ranked way up there. It was producing 21 million ounces of silver a year. So they're down considerably. And again, there have been people killed. And I don't think people understand this, that Tahoe used a kind of a paid military defense system, contractors, to protect the mine. Now, that doesn't sound like something to me that is in the best interest or is in favor of the local people. So there's a lot going on there that people in the West don't understand. I do know that Norway and the Netherlands, two of the larger pension funds, they actually dropped their Tahoe Resources investments because of what they see as big trouble with the mine. So I don't know. I do think, and we can get into this too, Chile's silver production is down like 20% because of a closure of a few or strikes of a few copper mines there. And then in Australia's silver production is down 19% so far this year. So we're going to see actual falling global silver production this year.
Well, only from maybe primary silver miners, like you said in your article, because I think, with higher copper prices, higher lead and zinc prices, there's going to be a lot of silver byproduct that either was going to come offline if those base metal prices had not risen like that. And now potentially, Steve, I'm seeing new base metal mines starting to get funding and moving along the track to production. They have silver byproduct and gold byproduct as well. But before we go into, my theory that maybe, these base metals were manipulated higher to keep annual silver production, at high levels, even though I think it's rather obvious that the primary silver miners are struggling. That's an interesting point you made about Fresnillo. I actually didn't know that they have higher revenues now in gold production than silver production, but that confirms what we're seeing, with Coeur d'Alene, with Hecla, with Silver Standard. The last couple of years, Steve, these companies, they basically, they're known as large silver producers, but if you dig into their investor presentations and their financial statements, the majority of their revenues, they've been buying gold mines, producing gold mines or near production gold mines. The last couple of years, they've been trying to get out of the silver business. Diversifying their revenues is what they call it, but they've been trying to get out of the silver business. And a lot of the silver mines they do have, a lot of the revenues are from larger amounts of base metals rather than silver. So I think, at the current prices we have for primary silver miners, there really is no long-term silver business.
And you do bring up an interesting point, because I've seen that they're adding, a lot of these primary silver miners have been adding some gold projects. And what's interesting about Pan American Silver, which is one of the larger primary silver miners, I looked at their financial report in the third quarter of 2017, and they made money, but they made money not because of the silver price. They made money because of the base metals, copper, lead, and zinc. They have held up pretty well. Well, as you'll talk about, the price of copper has gone up. So they actually made more money on their base metal sales, and gold has kind of held up pretty well. It's silver that has fallen from like $19 last year to a little bit more than $16, $17 this year. So yes, we're seeing that. We're seeing that it's become tougher and tougher for the primary silver miners to do production. And so I do think the issue going forward, if we finally see a crash in the markets, that's when we'll see silver production fall, but it will be in the base metal, from the base metal mining industry. But if things continue to go as they are, Jason, we could see more production, byproduct silver production, coming from the base metal mining industry.
Yeah, this is actually perfect. What's happening right now is actually perfect for the bullion banks, the people who are manipulating gold and silver. So I'm not sure if they're directly doing it or if they're indirect beneficiaries. Maybe the Chinese are the ones who are stockpiling. Maybe it's private sector Chinese companies or state-owned enterprises in China, or maybe it's the Chinese government for one of their massive, One Belt, One Road, Silk Road infrastructure projects. I'm not sure who's accumulating massive amounts of copper, lead, and zinc, but it is benefiting whoever needs physical silver but wants to keep the paper silver price under control. So there's an even larger divergence now. But one other thing, Steve, about the primary silver miners, did you watch Keith Neumeyer's presentation from the Denver Gold Forum in late September? He said some very interesting things in there. Normally First Majestic Silver is known as like the bottom quartile for lowest cost producers, not the lowest cost producer in the world, but one of the lowest cost, bottom 25%. And so he said, basically, he was like, look, we've had a bad last couple quarters. He was like, it's because we can't cut our costs any further. And the reason we can't cut our primary all-in silver costs any further is we don't have enough capital to make the investments into either new technology or going and finding new exploration successes in order to make the investments to lower our costs long term. So, something has to give here. If First Majestic Silver cannot perpetually cut costs, what does that say about the rest of the primary silver miners that has higher costs then?
Well, you bring up a good point, and we have to remember I've done analysis on this. I've looked at the cost of producing gold and silver, and copper. You can include copper. You can include most metals, and actually most goods and services as well as energy. The price seems to be, if we look at the long term, I'm not talking short term, which is affected by supply and demand, but if we look at the long term, over 100 years, the market price of gold or copper or whatever, silver, is based on its cost of production. because there aren't any companies out there that are producing silver at $4 and they're making, $12 or $15 or $13 an ounce. There's just no one doing that. Or there aren't any silver companies out there producing silver for $55 an ounce and selling it for 16. So what we look at when we average everything, the market prices of these metals are based on the cost of production. Now, the problem is it's not just energy energy is the major, let's say, factor that is the cost. It thunders through the whole industry. So when the oil price fell from 100, now it's in the 50s, then the cost fell. But we have to remember in the last 10, 15 years, the average ore grade on the top primary silver miners has fallen 50%. So there's two things going on. Even though costs have fallen, energy costs have fallen, ore grades continue to fall. So you have to move more material to produce the same amount of silver. So this is another aspect of the problem with the management to continue to keep costs lower, because as you said, they don't have the capital to increase more yardage, more tonnage that would bring down the cost. So it's a double-edged sword, and I think it just becomes more of a problem if the silver price doesn't increase.
I agree. I think we're going to have, I've been saying this for a while now, we're going to have $25 to $30 an ounce silver so the primary silver miners can make profit. They can reinvest that into long-term cost structures, into making sound long-term investments. And a lot of the new primary silver mines, other than this Mag Silver project, which is amazing. I think there's over 3 billion ounces of silver resource there in Mexico. That's one of the best silver mine discoveries of the last 20 or 30 years. And that's going to be extremely low cost, but that's not a normal junior, because Fresnillo is the JV partner with Mag Silver there. I mean, the other low-cost silver mine, I think, is the Alexco startup in Canada. That needs $19 to $20 an ounce. Pretty much every other potential new primary silver mine, Steve, that I've looked at needs $25, $30 an ounce silver minimum. So I don't know how this industry is going to survive unless, maybe demand for physical silver drops. But I don't see any evidence of that really. And I actually see physical demand for silver outside the United States, physical demand for silver for industrial purposes, physical demand for investment silver in India and China pretty strong still.
Yes. There are two factors in the value of silver. There is its cost of production, which is based upon like a commodity. It's used and consumed in the industry. And that's how that's how markets determine a price, because an industry is not going to pay 50% or 100% more for metal. They're not going to do that. I mean, maybe on a huge price spike because there's a shortage, something broke down, there may be some volatility. But there's another aspect to value silver, and that's its store of value or its function as money. See, silver is supposed to be saved, like gold is saved, put into a vault, but there's less silver. You see, if you try to save corn deteriorates, or if you put it in a home does have value, but if you don't continue to maintain it, the home depreciates, it falls apart, it becomes old. So cars the same way. A lot of assets deteriorate. Gold and silver do not have that problem. Silver a little bit more than gold. Gold holds up better over time than silver, but the thing about silver is a fantastic way to store wealth. Most stocks, bonds, and real estate, Jason, are horrible ways to store wealth. They are okay when you've got good energy production, cheap energy production, but they become very problematic when you have a falling energy supply. And so that is when I see in the future the value of gold and silver reaching their high quality store value. And we could talk about that maybe later.
Well, stocks and bonds have done well, Steve, since the 2008 financial crisis, because global central banks, the largest central banks like Federal Reserve, Bank of Japan, European Central Bank, Bank of England, People's Bank of China, they've coordinated and they've created tens of trillions of dollars in money and credit since 2008. So, normally you may be right about stocks and bonds not doing as well with normal market forces allowing bankruptcies, depressions, free market corrections, but we've had, unprecedented levels of interventionism and market manipulation and coordination trying to keep regular asset prices like stocks, bonds, and real estate higher. Now, I want to, before we get into maybe some other subjects, I want to ask you about the theory that I've been putting out there really for the last couple months. My theory that copper and lead prices were moved higher. There's not really any fundamental justification for this in the real economy with industrial demand, China slowing down a lot, to keep the same or more silver byproduct available. What's your thoughts on this?
Yeah, I listened to your video, and it is quite fascinating to see the decoupling in the copper and silver price. Both have been, running kind of hand in hand, neck and neck. And to see copper really move up in 2017, while silver has lagged. We can think of many different, speculate why that is happening. I did do some research on the financials at Coldeco, which is in the Chile's, one of Chile's largest copper producers, and Freeport-McMoRan, and that's one of the larger base metal copper producers. Well, when you averaged their profit for the first 9 months of the year, copper came at 5%. Silver came at 6% and gold came at 9%. And I was using Barrick and Newmont, and I was using Pan American Silver and Core to get those figures. They'll be off when you start adding everybody in there, all the different miners and the different industries. But I think the issue is, yes, there is a lot of silver. What the problem is, there isn't a lot of copper stored like in ETFs, or I think there's over 2.5 billion now of silver ounces that is actually stored in custodial vaults, or is supposedly in ETF vaults across the world. But we don't have this kind of copper. Now, there could be companies in China and around the world have stockpiled copper, but nothing near the amount that has been stored for silver. So the idea that maybe they're trying to continue keeping the base metals strong because they need base metals for every reason, silver is not really an issue. Because we have supposed stocks of silver that could be tapped into if we needed to. So you bring up an interesting theory, and it sounds plausible. I don't know what is happening, but I don't think copper is a good investment to own in the future. I see a collapse in the copper price once we get a fundamentals finally come into the markets, and we see the Dow Jones and these markets crash because, oh my gosh, I don't know about you, Jason, but to see the Dow at 24,000, it's unbelievable.
Yeah, I mean, as long as the central bank, Steve, can keep creating more money and credit out of thin air, it's any of these asset prices going higher. It's really seemed that the hedge fund managers are calling this the everything bubble, but it basically seems that like everything is going up but gold and silver and mining shares and precious metal mining shares. So basically, everything is benefiting from this central banker easy, cheap money and liquidity credit that's being injected. I mean, the Chinese have just, a lot of the mainstream financial media is kind of ignoring this, but the Chinese have just created enormous amounts of money and credit in the last 5 to 7 years to stimulate their own economy. And you have the head of the People's Bank of China in the last month or so talking about a Minsky moment there. So I think that's interesting. But you brought up above ground ETFs for physical silver. I mean, I'm not sure how much of that physical silver is actually there and how much has been taken out, because if you go through the prospectus of the SLV, I think there's a lot of legal loopholes there. So, unless there's actual real independent audits with the serial numbers and bars, I'm not sure I believe how the exact number that they're stating in physical silver is above ground. And I've talked, with a lot of other experts like this, with Eric Sprott, John Embry, many other people in the gold and silver community. I would believe the numbers if there was actual real audits with the serial numbers, but there's just really not. So we have to. I'm not going to take it on the grain of faith because these banks, whether it's Deutsche Bank and others, they've just been fined for manipulating so many markets, whether it's LIBOR, manipulating the London gold fix, the London silver mix, silver fix, so many other different markets. So I don't think I can take on a leap of faith that all that physical silver they claim is in the SLV. And that 2.5 billion ounces is paper silver, probably. Most of it is.
Yeah, now you could be right. And I said the supposed. The larger number is the custodial vault. And again, we've looked at over the past decade, since 2007, a lot of investors, large investors, wealthy investors, have been buying silver. And I talked to dealers. And so when a large investor, wealthy investor, buys 1 million, 5 million, 10 million ounces of silver, they're not going to store it in their backyard. They're going to store it at a vault. And that is what is known as, the term is a custodial vault. Oh, okay. So the estimation is there's 1.5 billion ounces of investor silver, which I don't think is going to come back in the market, really. That's tight. That's in tight hands. And then there's like 660 or 70 million ounces in ETFs. I don't know what amount is actually there. You're right. Nobody really knows. But there is silver there. But I do believe it's the investors are holding on to it. I don't see that being dumped in the market. Not at all.
Okay, that's interesting. And so for my last couple points here about, my theory that I have, I think my estimates are that, if the copper price and the lead price had stayed at very low levels, say copper was below $2.50 a pound, maybe back around $2.30 a pound, at those levels, Freeport-McMoRan almost went bankrupt 18 months ago. So there was huge potential mine closures. A lot of the copper miners actually didn't shut down mines, actually didn't go bankrupt because there was a relief rally. The divergence in copper and silver prices, Steve, actually started around, I went through this with the short video, around January of 2016, and then it started to get wider and wider and wider to levels it is now. Whereas, they had been very tightly correlated in the past because, there's normally a large amount of silver byproduct with copper mines. But, there might be, Steve, if the copper price was a lot lower, that could have potentially affected around 100 million ounces or more of silver byproduct. So this is, this theory that I'm saying, this is not a small amount of silver. This is a potentially large amount of silver byproduct that if prices had been lower could have been in jeopardy for annual silver supply.
Oh yeah, I agree, and it's you're correct. I do remember seeing Freeport-McMoRan. They're in big trouble in the beginning of 2016. A lot of people were in big trouble. That's when the oil price fell to 30, and it seemed like the commodities and the metals had sold off into that. And so, yes, they were in. A lot of the companies were in big trouble. And so, let me just say this: there was an interesting article about the 1987 market, 25% market crash, and how much it resembles what's. A lot of people don't realize in '85, the oil price was $30. It fell to $8 in a very short period of time. Very similar to $100 oil in 2014, and it fell to 30 by beginning of 2016. Now, what happened in 86 and 87, the markets recovered, the oil price recovered, so it looked like things were going in the right direction. But we had this huge crash in 87. Now, what is similar is that there's this huge VIX trade, this huge short VIX trade. And if you look at some of the articles published on Zero Hedge, they talk about this huge VIX trade that has been it's like a naked VIX trade that when the markets start going the other way, there's really nothing that's going to be buying back these VIX contracts, the volatility index. And so it's going to see an explosion of the VIX index higher. When that happens, then the Dow Jones sells off because they go against each other. They're the opposite. So I do think we're heading into another 1987 type of event, even though the central banks are in there. The central banks couldn't stop the stupidity of the people doing, the mortgage-backed security, and they couldn't stop the idiots in the same thing in 1987. So I think we're heading to a perfect storm. I'm not saying it's going to happen this year or the beginning of next year, but I think we're going to see a massive correction with the markets.
Yeah, I did a short video a month or two ago on the leverage short volatility trade. Hedge fund manager Christopher Cole of Artemis Capital says that it's up to around $1.5 trillion in size when you add in all the leverage. There's a bunch of very large pension funds and hedge funds, investment banks, even day traders now who are piggybacking this trade. This trade started with central banks, going in there, plunge protection team groups going in there, trying to move the stock market higher. And so, they're not just shorting the VIX. They're not just selling puts on the VIX. They're also, selling puts, selling short straddles on the major stock market indices too, like the Dow, the S&P 500, the NASDAQ, betting those won't collapse either. So this is, this is fed on itself. It's become a vicious cycle where people think it's easy money. But last question, Steve, before we switch topics about the gold and silver miners. So if silver, at $16.33 an ounce silver, they can tread water. Let's say silver goes another $1 or $2 an ounce lower. For every dollar, are we at the levels now, Steve, for primary silver miners where every $1 or $2, there's going to be 30 million in ounces or more of annual silver supply affected that is in jeopardy of, either the mine gets shut down, put on care and maintenance, or the primary silver miner maybe is in jeopardy of going into bankruptcy? Are we at those levels again?
We could be, and then there's the avenue of the bankers who continue to supply the let's say lending to companies. Chris, it's one thing if the price of silver fell to 10, and then you're just losing multiple millions and hundreds of millions of dollars in the industry. But if it's falling like $1 or $2 below your cost of production, then you're going to have to have either cash or you're going to have to start getting into your credit facility. So I think the banks are going to be very happy to continue lending to silver producers that are losing money. So it depends. I do know some companies have cut back. I think Endover Silver actually shut down one of their mines that wasn't really economical. So if we do see, here's how I'll put it. If we see a continued lower price, it stays there of 15, 14. I don't think we're going to go there. But if we did see a continued low price, and it stayed there for quarters, yes, I would see we would lose more production. But if it's just a sharp bounce down to 14 or 14 and a half or 15 and it comes back up, no. So if we do see lower prices, sustained lower prices, we could see more primary silver mining production come offline.
Yeah, and long term, this is, even if prices stay here for a little bit longer, go a little bit lower and stay here for another couple quarters, maybe a year, this is long-term causing big supply problems because the miners just don't have the capital to replace their reserves adequately. Most of them don't. So something's going to have to give in the near future. I would be surprised if we have silver around these levels in another 3 years, maybe even less than 2 years, because I don't know how much longer the miners can survive. But, if there's a lot of silver byproduct available still, or demand for physical silver, either on the investment side or the industrial side, were to fall, maybe the bullion banks and the manipulators can keep this balancing act going for a while. Because a lot of people think, that the manipulation is black and white, but I think it's more sophisticated and complicated than that. It's basically a tightrope that they have to walk. So they wanna manage the paper price, but they also still need the physical supply. So they can't totally just, bankrupt all the miners, because then they won't have the supply to give to either people want silver for investment demand in China and India, because no one in retail right now is buying silver in the United States or Canada. I see the comment section, people are like, well, why are you still even talking about gold and silver? So that's a contrarian indicator. The other thing is, the industrial demand. There's still enormous amount of industrial demand for physical silver because there's a lot of new inventions that are coming online in the next 10 years or so, that even more silver is going to be needed. It's going to be needed in smaller amounts, but new ways to use industrial silver.
Yes, and I have a little bit of a different opinion on maybe the timing of these events going forward, and maybe once we get into the energy, because you see, the energy to me is very problematic, and I don't see it being something that is going to slowly change, or let's say production slowly decline. I think we're going to see cliff-like declines, and it's going to be very disruptive to the market. And when that happens, Jason, then we're going to see huge movements in the metals, because really there aren't many true stores of wealth out there. Liquid. You have to remember, in a very depressed economic market, you can't sell your home. The prices are going to continue to fall. People are losing their jobs. So all this money that was sunk into all these new homes, these suburban homes, thousands, hundreds of thousands of homes built, it's going to be kind of sunk. You can't sell it, and that's the issue. However, a gold and silver coin doesn't have that same problem. It's not sunk capital in something that's not liquid. And so, or like an RV, we've seen so many RVs being sold over the last 2 years. Everyone gets in an RV, they just want to get out of town. It's a rat race. But, during a very depressed economic market condition, no one's going to be buying RVs. So if you spend all this money buying an RV, you can't even sell it. That's where the promise of the gold and silver coin is going to come. And unfortunately, the market does not understand that.
Yeah, and I've read your articles in the past, Steve, about how each gold and silver coin or bar that's pulled out of the ground, it stores not only purchasing power, but it stores the energy that was used to produce it. So it's a very interesting argument, but Americans don't really understand that oil can't stay at $20 or $30 a barrel permanently, that there's not unlimited supplies of it. So basically every time the gas price falls, the sales for SUVs and trucks, they spike like crazy, because people are like, well, my gas is cheaper, I may as well go out and lease or buy a new truck or SUV. But let's talk about the oil and gas market. There's been a lot of volatility in the oil and gas markets. There's always volatility, but it seems like there's been more volatility lately for geopolitical reasons. What's your opinion on the shale companies right now? It seems that they weren't profitable at $100 a barrel oil. It seems like, they have almost unlimited money and credit. I thought more of these companies would go bankrupt. What's your take on that industry?
Good question, because when we had the market crash in 2007 and 8, everything was falling apart. We can remember how the fear that was in the market, even in the government, they stepped in and were propping everything up. Well, back in 2007, the energy industry was in pretty good shape. Let's say Continental Resources, they're one of the larger shale oil producers in the Bakken, in the North Dakota Bakken. They had $165 million in debt in 2007. Not much at all. Well, if you look at their financial statements now, Jason, they've got $6.6 billion in debt. Well, what happened? Yeah, what? And they're paying $250 million a year to service their interest. That's like if you're a homeowner and you've got a credit card bill, you can't pay it down. You just can't do it. You're paying $250 million just to service your credit card interest. It's insane. So why did that happen? If we have all this wonderful shale oil and we brought it all on, why are these companies, why do they have all this debt? And let me tell you, there was an interesting chart that was put out by Bloomberg about the debt wall, which is the amount of bonds U.S. energy companies below investment grade need to pay back every year. Now, in 2016, last year wasn't much, $25 billion. This year, $65 billion. Next year, $110 billion. By 2020, it's $230 billion. 2021, $240 billion. And 2022, it's $260 billion. What they've done is they've bamboozled the public, the investors. They've taken their money. They produced this inferior quality oil that was not profitable, and the bag holders are pension funds, mutual funds, insurance companies, and they're holding the bag and they're getting an interest rate. But now some of these companies can't even pay their interest payment. So I think the shale energy companies, and I'll give you just one example. It's a shale gas company. It's the second largest natural gas producer in the U.S. It's Chesapeake. And if you're familiar with Chesapeake, they've been producing the second largest natural gas in the country. But if you look at their 9 months quarterly statement, their operating cash, it was $273 million. but they spent 1.6 billion producing the natural gas. So free cash flow was a negative 1.3 billion. They spent 1.3 billion more to produce the natural gas than they received from their operations. Now, how did that work? Well, they got clever and they sold properties worth 1.2 billion to fortify their balance sheet. But this is like the Depression. When the things get tough, you sell your car. Well, then you start selling the family jewels, the silver, to stay alive. Well, and when the things get bad, it's in the winter, then you start burning your furniture. Well, how long can Chesapeake do this? So basically, the shale energy industry is a disaster. I don't know how long it has before it disintegrates. I give it 2-3 years before it really disintegrates. And when that happens, the rest of the world would be insane to try to do shale oil or gas.
And before we started recording, you brought up how the larger oil and natural gas companies, the Statoil, the one in Norway, and some of the other ones are getting into this game as well.
Yeah, if we look at the majors, the majors are supposed to be the ones that are profitable. They have the better quality reserves. If we look at Petrobras, Shell, BP, Total, Chevron, Exxon, and Statoil, those are some of the major ones around the world. They had 84 billion in total debt in 2007. Jason, last year it's nearly 380 billion. Why on earth would the majors' long-term debt quadruple? Especially at $100 oil from 2011 to 2014. So when you start looking at the majors are in big trouble. Now we just heard.
Not only operation. Sorry, Steve. Not only operationally. Sorry to interrupt you. Not only operationally did some of these oil and gas companies, make bad investments, but they also, some of them did financial engineering, like ExxonMobil, where they've been buying their stock back at higher and higher stock prices. As the stock price went down and down, they just used more debt instead of replacing reserves, doing acquisitions, focusing on higher quality reserves, replacing oil and gas, maybe growing production. They haven't done that. Companies like ExxonMobil haven't done that. So now ExxonMobil has a debt problem. I'm not saying they're going bankrupt, but now they have way too much debt where they have to deal with their debt problem.
Yeah, and the issue, the reason for all this stuff, the reason why the world is in such big trouble, we can name a lot of symptoms, but the real reason is the falling energy return on investment. And I'll tell you what, I'll give you a perfect example of what this is doing. If we look at these same 6 major oil companies, actually 7, in 2004, the price of oil was $38 a barrel. Well, these 7 oil companies, they made nearly 100 billion combined in net income. That's not bad. Well, last year, the price of oil, even though it fell, it was higher than 2004. In 2016, the average oil price was about $44 a barrel. It was $6 higher. Well, you know what? These 7 oil companies, they barely made 10.5 billion with a higher oil price. So what we're seeing,
profits are down 90% in 13 years with a higher oil price.
Yes, and that's the falling energy return on investment. It's gutting everything. And so this is the issue we're facing. I call it, we are now in the cannibalization of the oil and gas industry to stay alive. They're going to sell assets. They're going to borrow money. And so when you barely can make your interest payment, this is not something that's going to be sustainable for decades. We're now approaching the end times. And I really believe the U.S. shale oil industry could likely disintegrate within the next 2-3 years. There's some interesting information that I have to keep private, that I believe there's been some improper reporting of data. And I think that's gonna come out here in the future. And so when that comes out, it's going to put less trust into an industry that hasn't made any money. And so when you add all this up, and this is how I'll conclude, Jason, the world runs on energy, not finance. Energy drives the economy. finance steers the economy. Well, finance is steering us over the cliff, but without the energy, nothing is possible. And so this is why it's important, I believe, to focus on the energy, because the energy is going to give us a clue what is going to happen in the future.
And the financialization, the finance sector, Wall Street, large global large global central banks, some of the larger ones I mentioned earlier, I think they've helped paper over some of this oil problem. They bought time and created the shale bubble, and these shale companies went crazy, but none of them really made any money. They didn't pay dividends. They didn't generate free cash flow, even at much higher oil prices. If they didn't have all this artificial cheap money and credit, if they didn't have Wall Street collecting enormous billions in fees and issuing them ridiculous junk bonds, they didn't have pension funds willing to lend them money, desperate for yield, because central banks have created financial repression and made it very difficult for anyone to get halfway decent income without taking enormous risks, then I'm not sure the shale industry would have gotten to the levels it has now. And yet, here we are. The other thing, Steve, that you mentioned is with the bad data. I mean, one of the things I've noticed about the oil industry is I think they're basically what primary gold and silver miners were about 5 or 6 years ago, where the primary gold and silver miners were fraudulent. They were lying about their costs. I mean, they would only report years ago about their cash costs and say, we're producing silver at $5 an ounce cash costs, or we're producing gold at $600 an ounce cash costs. And then you look at their financial statements and see their cash flows, their net income, and there was no way that those were the real costs. So the oil industry, Steve, a lot of them, especially the shale guys, have gotten away with this. For a while now, the oil industry has just been reporting their lifting costs, which is just at the wellhead, does not include a bunch of their other costs, their capital costs, their exploration costs, their transportation costs. None of those costs are itemized in their costs, and then the cash costs. So I think that industry needs to be more honest and transparent with their costs, and that's how also they've been able to get away with raising so much money in equity and credit so much, is because they've lied about their costs too.
And that's true. And a negative issue or negative factor with this very unprofitable oil is that it's destroying a lot of infrastructure across the United States. For example, a lot of these companies they just can't pay enough taxes to help replenish or help maintain all these county roads, because we have to remember it takes fleets of trucks to produce one shale oil or gas. It takes fleets of trucks to get one oil or gas well going. So you have a lot of road damage. Well, we're hearing, especially in this infrastructure report, that the American Society of Civil Engineers came out, said that a lot of the U.S. roads are going back to gravel. They just don't have the money to maintain them. And also because a lot of these energy companies are having these trucks go all over these county roads to get to these different wells, and they're destroying the roads. Trucks destroy roads much quicker than cars do, and they're heavier. And so they don't have the money to pay the county or the local areas to maintain these roads. So now we're going back to gravel. Does that sound like a country that's going to move into a new high-tech world? I mean, people just need to realize and look at this stuff objectively that yes, we could see more technology move in, but I'd like to conclude by saying technology costs energy. The more technology you throw at something, the more energy you need. So it's actually it doesn't solve a problem; it creates more problems. And so the more complex the technology gets, the more problematic and fragile it is, and then the more energy it takes to run and maintain it. It's a disaster in the making. So I have a very negative view or forecast of what is going to happen in the United States and across the world, because we just don't have good quality energy to run all this stuff anymore, much less grow.
And I agree with you about the U.S.'s infrastructure. There was according to the billionaire Jack Ma, I think, who runs Alibaba, he said that the United States government has wasted $14 trillion in the last 3 decades on foreign wars that should have been invested on the American citizens into improving our infrastructure, putting better public transportation with maybe maglev or bullet trains all over the country, etc. I'm not for central planning. I'm a free market libertarian, limited government guy, but that money was spent and it was wasted. So it could have been spent a lot better than that. We were discussing before we started recording about Bitcoin mining, and the cost for Bitcoin mining going up and how much more energy it's using, even though there's, new investment capital going into Bitcoin mining now and, new technology being applied to the mining rigs, the costs are still rising. So, that with the technology and with all the central bank intervention, I think, Steve, technology is supposed to make people more productive, make people more efficient, and instead things are getting so complicated, like you said. I think it's creating a divergence now. So in the society, it's actually increasing the wealth gap between the haves and the have-nots. So, some people may be better off with the central bank intervention. If you already owned a bunch of different types of assets like stocks, bonds, and real estate, you're doing really well since the central banks came in 2008 and reflated everything with the wealth effect. And with technology, if you were a computer programmer and you understood what Bitcoin was in 2010 or 11, when it was initially, people were starting to talk about it, and and you bought some, then you're benefiting. But what's coming, Steve? What's coming? Forcing people to go into technology when they really don't want to learn it. It's becoming a very complicated society, and it's not really fair. But that's how things are going right now. So I'm worried with this cryptocurrency. Some people are making a lot of money off of it. I'm seeing people on Facebook who I didn't even know read anything about finance talk about day trading cryptocurrencies, and I'm just worried that the governments are going to come up with new ways now with the technology behind blockchain to track and tax every transaction, take away our freedom, and make our lives harder.
Well, anything is possible, and I would agree with you that the trend will go that way. I don't see the government saying, well, we're going to stop NSA spying, we're going to stop controlling everything. And we know Google is watching everything you do, because if you look at something, I looked at a Bowflex workout machine 3 weeks ago. Do you know I still get ads showing up on my website after 3 weeks? This is not a good thing to track people, and it actually doesn't work. The Google model is falling apart. Not only because of ideology, because it's a business model that's really not functioning anymore. However, let me take it back. This is important for me to say this, and I don't want to repeat myself, but the idea that technology is helping us. Back when we were hunter-gatherers, when you went out and hunted and gathered food, you got 10 calories worth of food by expending 1 calorie of energy. So you had 10 plus. It was a good gain. Well, when we left that, we said, you know what? I got a better idea. I don't want to go around looking for food, and I want to actually grow it myself. Well, when we started simple agrarian farming using simple hand tools, the energy return on investment fell to 5 to 1. 1 calorie of energy, we got 5 calories worth of vegetables. So, but then we said, you know what? I got a lot of people. We got a lot of big village. I got a lot of kids. I'm going to use an oxen or a cow or a horse to move the plow. Well, when you include a large animal, the energy return on investment for farming falls down to below 2 to 1. But that was okay. Why was that okay? Because we had plenty of forests to cut down, and we could turn those into pasture. We weren't considering the energy of the grass, the hay, that the animals were eating for the energy that we use them for plowing the fields or harvesting the fields. Now, let's move forward to today. Well, what are we doing today? Well, by the time we plant, harvest, and process and transport a can of corn and it ends up on your dinner plate, we have burned 10 calories of energy to get 1 calorie of corn on your dinner plate. It's a huge net energy loser. The only way that system functions, Jason, is if you have positive energy return on investment of energy, which is oil. Unfortunately, shale oil comes in at an energy return investment of 5 to 1. So shale oil isn't paying our bills just to maintain our agricultural processing and distribution system. We can't maintain our food system with shale oil. So this is why we're in big trouble. We are importing oil from from Saudi Arabia. It's a higher energy return on investment, but the trend is going down. And this is a much different situation in 1930 when the U.S. oil industry was producing 100 barrels of oil for the cost of one. 1970, it was 30 barrels to the cost of one. And during that time, after World War II and up to the 70s, we produced most of our infrastructure during those 20, 30 years because we had the profitable energy to do it. We no longer have that. So again, it comes back to the energy, and even though the cryptocurrency, the high complex electric internet market system will continue for a while, it is going to come under big pressure. I see the grid disintegrating. We just don't have the energy and the means to maintain it. There will be islands of technology. There will be islands of technology be used in the future, but for the masses, I don't see it. So what that looks like and what happens, I would rather be holding most of my wealth in physical precious metals than in cryptocurrencies.
Yeah, I think there's a lot of things happening throughout the economy that governments or big technology who's corrupt and basically cartels with government protection that they're doing to the average person on Main Street and making not their lives easier, they're making their lives more difficult. I know, you brought up how Google's evil, spying on you with ads. Well, I think Google, they've screwed over a lot of people in our community with censorship. They've stopped. My channel is still growing a decent amount, but it should be growing a lot more than this. They've taken my ad revenue, my Google AdWords revenues down enormously. So you have started new ventures, the Commodity Ad Network. Want to tell the listeners about that before you go?
Yeah, thank you, Jason. I'll just briefly mention it. My webmaster, Peter Froelich, he's not only a genius, he's very good at business. And it's very rare to find someone who's very tech savvy that is very business and frugal. They don't seem to run hand in hand. He has that ability. So he's designed this ad network, and we actually have 50 websites that have applied to join. And there's some very good ones like the Activist Post. They are ranked pretty high up there. They're an alternative news network, and they had their YouTube channel banned about a month and a half ago. I spoke with the editor and I asked him, well, what's happened? He goes, well, they're just giving us a canned reply. We'll never get it back. Well, Jason, we see this continuing to happen on YouTube, and then it's making its way now on the websites. So what we're trying to provide is an alternative for the alternative media publishers. They can come on our network. We expect that we're going to be paying them double what they're getting from Google. May take a little time to do that, but they will be getting more money. We offer any website that joins our ad network that's going live on January 1st a sign-up bonus worth up to $1,000 depending on your traffic. So all we're doing, Jason, is we're going to get alt media advertisers, precious metal dealers, alt media newsletters, resource newsletters, maybe survival prepping goods. We want them to advertise on our audience who are looking for those kind of products. And so it's a perfect match. And when it's private, we're not going to be tracking anybody. We don't believe in tracking anybody. It's a different way of doing advertisement. We actually think it's much more successful because 20% of the forecasted $82 billion worth of online digital advertising this year is going to be ad fraud. So $16 billion of someone's advertising budget is going to be blown. Well, we're not going to have that problem on the Commodity Ad Network. So we want to help the alternative media message. We want to help it prosper and grow. And the best way to do that is to help pay the publisher more money so they put out good content. We give them a shot in the arm, and as well as we're not going to censor them. We're not going to censor them. We don't believe in racism or hate speech, but we're not going to censor people for putting out the alternative media message. We want them to do that. So if they go to the commodityednetwork.com website, there's a short one minute video that explains what we're going to do. If they want to sign up as a website, you could sign up, or as an advertiser, you could also join our network, and we're reaching out to advertisers right now. So we appreciate anybody checking us out, and we believe the Commodity Ed Network is really going to grow double digits month over month when people finally see it live, because a lot of people are in the wait and see, and I understand that. So thank you again for letting me share that.
Before I let you go, Steve, I want to add something to what I wish you and your business partner the best of luck with Commodity Ad Network. I think that YouTube, Google, Twitter, some of these other large social media platforms that are essentially cartels with their content, I think, you know, they're very political. The people at the top of these running these companies are extremely political. So, you know, they've been targeting, if you're a libertarian, if you're pro-Trump, if you're just a regular Republican or conservative, you've been unfairly targeted. And I think the mistake that they've made is they're overconfident. They think that their platforms are the only ones. And instead, you know, over the next couple years, Steve, there's going to be a lot of competition coming for them. People who have good content like you, who have good content like me covering different topics, people who have content, you know, covering more of the social issues, how society in Europe and the United States is changing drastically due to cultural Marxism and other things, and social engineering. You know, people who cover these topics that I find interesting, the people at those big technology companies think that they could bankrupt them financially, shut down their content, make sure their content doesn't grow, people don't see it, and they'll just go away and stop making the content. That's not what's going to happen. You know, people like you and your business partner and others are going to come out with new ideas. They're going to go for it. And people like me, we're going to look for new avenues to put our content. So, you know, I've already thought about moving a lot of my content off of YouTube. I haven't done it yet, but, you know, in the near future, that may happen. And I think a lot of people, if YouTube continues to want to do this, that they're going to be very political. They're going to target specific groups. You know, that's exactly what's going to happen. And over the next few years, they're going to lose a lot of their market share. They don't understand this right now. They think that, you know, we're just little bugs that they can squash, and they're going to keep making a lot of money, and that their political agenda is going to keep, you know, advancing. But that's not what's going to happen, I don't think.
Well, you may be right. Unfortunately, if we go back in history and look at what's happened to different races of people, different issues, it's like the hope is that the alternative media message and competition will allow the dissenting voices or the alternative message to get out. But let me tell you, I've gotten in contact with certain people. I've heard certain people say, well, you know, Google contacted me and they said, well, we don't agree with this content. If you get rid of it, then we'll continue giving you the ad revenue or a certain amount of ad revenue. And they said, okay. You see, censorship works. And that's what they're trying to do. They're trying to censor. They're trying to censor it. And that's the first step. But I think they could be successful, because 40% of my visitors to my page every day, my SRS Rock Report website, are unique views. Well, they have the capability to totally reduce that number. So, and I mean, the Google CEO said this, and I believe Sean at SGT Report showed this on one of his videos. He goes, you know, we want at Google, when they do a search engine, we want to provide one answer, because we don't want to provide different answers. Well, they want to control what people are searching. Now here, let me conclude with this. The first thing that the Commodity Ad Network wants to do is work on the competing ads to help the websites. Once that becomes successful, Jason, we're going to move to an alternative media search engine. We're going to do an alternative video platform with advertising, as well as social media. So that is the dream. We believe we can get there because we're going to provide the service. Google won't provide the service that we're going to do, as well as the benefit of a higher ad revenue. So with all this with all this together, we really think the network would grow, and we do want to be a part of a system that can really help promote the alternative message, not hurt it.
Well said. And, more competition is always, as a libertarian, more competition is always good from these large technology companies. They benefited from being allowed, competition when they were small. And now they've gotten so big so quickly. And now they basically have, they've basically stopped a lot of the competition for a while at least. And they have, cartels and essentially monopolies on a lot of their content. But, now that I think this really, the censorship for me, Steve, started a little bit before the election, so about 18 months ago. And, it's a lot of my growth basically in terms of views per month, in terms of new subscribers per month, in terms of my Google AdSense revenues per month are down 90%. And so it's just really unfair what they've done. But like I said, I really wish you and your business partner the best of luck. I really applaud you guys for trying it. And I think there's going to be successes here. I think people in our space and in other spaces who are being censored, they've left the door open. I had a consulting call. One of the YouTube's employees emailed me randomly a couple months ago, and I booked like a 15-minute call with a lower level YouTube employee, and I just politely but brutally honestly let him have it. And so I said, you know what, you guys think you're going to financially bankrupt us and you're going to stop our content, and we're just going to take our ball and go to another place because someone's going to figure out how to build a platform, and we're going to go there. So I wish you guys the best of luck. And this is a very interesting world we live in now, because the rules unfortunately are constantly changing, whether it's governments or central banks or big technology. So people, who are thinking that things were the same in the past, the only constant right now is change, and it's accelerating rapidly.
Yeah, I totally agree. And we, if we just look at Google in a business and we forget the ideology, if we look at Google as a business, it kind of reminds me of what happened in the 80s, late 70s, 80s with Apple, and the famous commercial on the Super Bowl with the woman running and smashing the screen, and that was like Apple destroying IBM. Google, when they first started, they actually provided a good product, a good online advertising service. It worked well, but now it's become too big, too inefficient, and only the large advertisers can really compete. Our ad network is actually good for the small and medium advertiser, as well as the small and medium content creator. So yes, if we go by business, if you get too big, too fast, you become too inefficient, there's always competition will always come behind.
And Steve, your articles are very thought-provoking. You've been really challenging a lot of people in the gold and silver community and the oil and energy community since you've started writing. So if our listeners want to check out your work, how do they do so?
Yeah. Thanks, Jason. You come to the SRSRockerReport.com site. I put out 2 or 3 articles a week. And so I am going to start doing videos now. And it's a shame I didn't do it earlier, because a lot of the stuff I do is easily understood, or much readily understood by graphics and videos. So even though I'm going to be using YouTube, it's going to be interesting to see how that goes until we come up with our own alternative. But I am going to start putting out some videos to explain these concepts, because I think people will understand it better when it's visually shown than on text. So I'll be putting out my first video within the next couple of weeks.
Very cool. And so if you do a video showing like the energy cost of Bitcoin mining, I think, putting Bitcoin in the title and doing a short video like that, I think you get a lot of views on that.
Yeah, and again, it was a great way to get the message out. And for some silly reason, I just didn't do it for the last 3 years. But yeah, I look forward to doing it. And thanks again for the time.
Wall Street for Main Street needs your help. Since the middle of 2016, YouTube continues to increasingly censor and sabotage the growth and success of my channel with dramatically slower or no subscriber growth, a huge decrease in views per month compared to 2016, and well over $10,000 lost in Google AdSense revenues the last 18 months. I should have been way over 20,000 subscribers and way over 3 million views last year, but it feels like I am Sisyphus trying to roll a heavier boulder with more and more additional weight up a steeper and steeper hill. In the last few weeks, all of my videos have been set to demonetization by default, and I have to manually protest each video. This is in addition to even lower than usual Google AdSense revenues after the adpocalypse started over a year ago for me. This has also affected my ability to get paid advertisers to agree to deals not involving YouTube, as I lost $3,000 per month in paid advertising deals at the end of June 2017 because all my analytics are down a lot thanks to YouTube censorship algorithms that have intentionally kneecapped the growth of my channel. With YouTube /Google/Alphabet /Don't Be Evil strongly considering demonetizing or setting all libertarian, conservative, or pro-Trump content to private to prevent any sharing or monetization, it is imperative I have a contingency plan to figure out how to make a living off my content. Each 30 to 40 minute video takes a few hours of my time before it's released to the public. There's a strong possibility that in the near future, YouTube will force me to move all or almost all my content to a new video upload website that allows free speech or behind a paywall on my own website. Thanks if you have already made a one-time or recurring monthly donation, and thanks in advance for any future donations as I decide the future of my channel and what to do with my content going forward. We accept one-time donations on the Wall Street for Main Street website via PayPal, Bitcoin, or Gold Money. You can also become a monthly Patreon contributor for $1 or more a month if you want to help me out. And don't forget to like each video on YouTube and share it with your friends and family if you think they would like the content.